Ladies and gentlemen, good day and welcome to the Kalpataru Power Transmission Limited Q1 FY25 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair from DAM Capital Advisors Limited. Thank you and over to you, ma'am.
Yeah, thanks, Steve. Good morning, everyone. Warm welcome to Kalpataru Projects International Limited 1Q FY25 earnings call. We have with us from the management, Mr. Manish Manoj, Managing Director and CEO, Mr. S.K. Tripathi, Deputy Managing Director, Mr. Sanjay Dalmia, Executive Director, Mr. Amit Uplenchwar, Director Group Strategy, and Mr. Ram Patodia, President Finance and CFO. At this point, I'll hand over the floor to Mr. Manoj for his initial remarks, post which we'll open up the floor for Q&A. Thank you and over to you, sir.
Thank you, Bhumika. Just a quick correction in the opening speech. It is now Kalpataru Projects International Limited and not Kalpataru Power Transmission Limited. Bhumika, you need to change your internal documentation also for that. Good morning, everyone, and thank you for joining us for our earnings call today. It's always a pleasure to connect with all of you. Let me first start with a quick update on the operating context before I get into more details on our performance for first quarter of 25. We have delivered a noteworthy performance in the revenue front with sustained earnings in the first quarter of 25. As most of you are aware that the first quarter of every fiscal generally has a typical seasonality of low labor availability and delayed collections. However, the severity this time was intense given general elections, as most of the manpower did not return to the sites timely, leading to lower than expected growth. Secondly, delay in collections from state utilities on back of pending budgetary allocations in the water segment also impacted revenue and collections for water business. Starting July, we have started to see improvement in collections in the water business, and we expect further moderation in debt levels and normalization of working capital in coming months itself. On the brighter side, business visibility remains strong and back of rising demand for electricity, energy transition, and increased focus on infrastructure development. The recently announced Union Budget also reiterated the government's thrust on capital expenditure and infrastructure. This is amply demonstrated from the fact that in first 4 months of FY25 itself, our order inflows including L1 positions have reached around rupees 12,000 crores. More importantly, nearly 90% of the new orders secured, including the L1 in the recent past, are in transmission and distribution and building and factories businesses. These orders are bidded and secured at better margins, which is in line with our focus to improve profitability going forward. Coming now to our performance for Q1. Our consolidated revenue is up by 8.2% to rupees 4,587 crores. 4 out of our 6 businesses have generated strong double-digit revenue growth, and particularly our flagship business T&D grew by 32% and B&F by 23% in first quarter of 25. The growth is driven on back of excellent backlog and robust project execution capabilities. I will further detail on each of the segments as we move ahead. We highlighted earlier we have started the year on a strong footing on the order inflows front. We have secured orders of over rupees 7,000 crores till date in FY25 and additionally have L1 of around rupees 5,000 crores. Our order backlog is up 21% to rupees 57,195 crores at the end of June 24. Our consolidated EBITDA stands at rupees 378 crores with a margin of 8.2%, while standalone EBITDA remains steady at rupees 314 crores with a margin of 8.4%. The performance on the EBITDA front largely reflects the nature of the project mix and increased investments in resource augmentation. Additionally, as a part of financial prudence, we generally provide 1.5% of our revenue towards warranty guarantee provision. Starting this year, we've also got eJMC business at same level as KPIL. This has led to increase in additional provision of 30 crores in Q1. The rise in finance cost is due to increase in working capital intensity and unrealized forex loss of approx 17 crores on foreign currency borrowings in our subsidiary in Brazil. Our net debt at standalone level is at rupees 2,907 crores. As indicated earlier, working capital intensity started to moderate, and we remain committed to bring net working capital days in our EPC business from the current level of 124 days to below 100 days business by end of 25. We believe a significant improvement would start from Q2 itself. In Q1 25, consolidated PBT amounted to rupees 137 crores and PAT at 84 crores. Similarly, standalone PBT stood at rupees 164 crores and PAT at 117 crores. The PBT and PAT for Q1 25 are in line with the revenue and operating trends. Our provision for taxation is at 28.7% in standalone business and 38.7% in consolidated business, which is slightly higher due to mix of revenue profit in international markets with higher tax and donations which are not tax deductible. Moving to segmental performance for the quarter. Firstly, in the T&D business, we have been stating since last few quarters that the outlook for T&D business remains very robust in India and globally, marked by rising demand for electricity, energy transition, and necessary improvements required in the grid infrastructure. Our tendering activity remains robust in India, Africa, Middle East, Americas, and Europe. Our T&D business secured orders totaling rupees 3,377 crores with an additionally L1 position of rupees 3,900 crores. We expect tendering and ordering momentum to remain strong for balanced part of the year in this business. We continue to scale up our T&D business both in terms of our global reach and capabilities in HVDC substation, design and engineering, just to name a few. Notably, the new orders received in the last few quarters in the T&D business are at better margins, giving us focus to improve profitability of the business going forward. Our T&D business reported a strong growth of 32% YOY to reach rupees 1,843 crores on back of a solid order backlog in domestic and international markets. Our international subsidiary LNG Sweden reported highest quarterly revenue of rupees 449 crores with a record all-time high order book of rupees 3,076 crores. It also secured its largest ever order of rupees 750 crores in Q1. In Brazil, Fasttel's performance has improved on back of closure of legacy orders. It has reported revenues of rupees 230 crores in Q1 with break-even activity and had an order book of rupees 1,200 crores. Our overall T&D order book is well diversified and stands at rupees 20,635 crores as of June 30, 2024, providing good visibility for robust revenue growth in 25 and for next few years. In our B&F business, revenue is up by 23% YOY to reach 1,226 crores. This growth is driven by strong order backlog and a healthy mix of projects. We continue to make good progress by improving the market position in large site EPC projects, and we have secured a large industrial and a prestigious high-end residential housing project this year. This advancement will greatly enhance our capabilities and provide us with good competitive edge going forward. Ordering activity in the B&F business remains robust with order inflows of approximately rupees 2,300 crores and an additional L1 of over rupees 1,000 crores so far in FY25. We will continue to be selective for the orders that have better margin, that are lower on capex, and have better value addition. We anticipate our B&F business to maintain double-digit growth supported by healthy order book and solid business visibility. Our water business reported a decline of 22% in revenue to reach 704 crores for Q1. As indicated earlier, the business was primarily impacted due to delays in collection from state utilities given general elections and delay in budgetary allocations. Additionally, shortage of manpower also led to lower progress on several of our large projects. We have taken several initiatives to ramp up execution and improve availability of manpower. Further, collections have started to improve in the water business starting in July itself. With a robust order book of 9,800 crores, we are confident that growth momentum will pick up in coming quarters in this business. Additionally, the government thrust on improving drinking water, irrigation, and sanitation continues as the same which was indicated in the recent budget. And we expect the business to continue its growth trajectory going forward. In our oil and gas business, we reported revenues of over rupees 250 crores with 18% YOY growth. This improvement is attributed to better project progress in domestic and international business. Our order book stands at over rupees 8,700 crores as of June 30th, 2024 in the oil and gas business. We have mobilized the required resources for the Aramco project and started with design and engineering activities. The progress on the project is expected to pick up in the coming quarters. We are looking to strategically scale up our oil and gas business both in terms of our capabilities and market reach. In our urban infrastructure business, revenue reached over rupees 180 crores, showing a YOY growth of 18%. The growth was slightly below expectations, mainly due to a manpower shortage. We are upgrading our capabilities and execution bandwidth in the urban infrastructure business and are confident that the business will deliver strong performance in the coming quarter. In the railway sector, revenue decreased to rupees 242 crores, reflecting our focus on project completion and selective bidding in light of intense competition. We continue to focus on segments like composite rail projects, metro rail, RRTS, DFCC, etc. in the railway business. In our road BOOT project, daily revenue increased to a record high of rupees 63.6 lakhs in Q1 25, up from rupees 61.7 lakhs per day a year earlier, and rupees 60.3 lakhs in the preceding quarter. Our combined investment in all three road SPVs stand at rupees 790 crores, including rupees 25 crores provided in Q1 25, mainly towards debt repayment and major maintenance. We are at advanced stage of divestment of VEPL and are hopeful to complete the signing of the transaction this quarter. In closing, I would like to reiterate our guidance for FY25. First, a combination of well-diversified order book, execution expertise, and strong balance sheet gives us confidence to achieve our annual revenue growth guidance of 20% plus. Second, business outlook and tendering activities remain robust. In this backdrop, KPIL is focused on orders that have better profitability, higher returns, and enables us to improve our capabilities and competitive position. We are targeting order inflows of rupees 22 to 23,000 crores for full year 25. The growth in the order inflows will be led primarily by the T&D and B&F business in the current year. Third, regarding margin guidance, let me reiterate that we expect margins to improve going forward. We believe our PBT margin to be in the range of 4.5% to 5% for FY25. Lastly, the underlying strength of a business model is based on profitable growth and maintaining a strong balance sheet. Going forward, our prime priority is to further strengthen our balance sheet through efficient working capital management, timely project closures, and divestment of non-core assets. We will continue to keep our debt levels aligned with business growth by targeting net working capital below 100 days and interest as a percentage of revenue at 2% on a standalone basis. Thank you for your attention. We can now begin taking questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Subhadip Mitra from Nuvama. Please go ahead.
Good morning and thank you for the opportunity. My question is with regard to the margins. While you have given us a guidance at the PBT level, where do you see your EBITDA margins stabilizing? And do you see a recovery from second quarter itself, or will it be more of a second half story?
Good morning. I think on EBITDA margins, we believe we should be at the level of 8.5% to 9%. But as I said earlier, we're more targeting the PBT guidance at 4.5% to 5%. As far as recovery is concerned, we are seeing recovery coming in Q2 itself. primarily because, collections have started coming in from some of the businesses and interest costs has started going down, and that will help us achieve our PBT margins, what we have guided. So we should see some recovery in Q2, but a significant recovery should start coming from Q3 and Q4.
Understood. Secondly, with regard to the promoter pledge, now that has inched up again. And, we are all aware how this has been a bit of an overhang for the stock in the past. So is there something that we need to be aware about? Is there any pressure on the real estate business because of which this is moving up? And secondly, is there a targeted range where you expect this promoter pledge to be?
So I think, promoter pledge currently has not gone up as compared to what we've seen in the past. From data which is in front of me, the promoter pledge is at 28.8% levels, lower than the 31.51% which was on 31st March. The promoters have also repaid some of their loan against shares in the last 1 month, and that was already notified by us to the exchanges. Our understanding from promoters is that pledge will only continue to go down from here, right? And we're already at 28% level, so you should see it only going downwards. And there is no way it would increase at any cost.
Understood. Thank you. That's it from my side.
Thank you.
Thank you. The next question is from the line of Parikshit Kandal from HDFC Securities. Please go ahead.
Yeah, so hi, congratulations on a decent quarter. So you spoke about some of the one-offs during this quarter. I think you said some additional provisioning and some donation was there. So if you can quantify what were the numbers above the EBITDA line?
So Parikshit, good morning. You are aware that, we always provide at 1.5% as a provision for warranty guarantee for erstwhile KPTL business. We have slowly migrated the erstwhile JMC business to also this level. It was at 0.5 earlier, went up to 1, and from the current year it is at 1.5%. Typically, it's a provision which comes back once a project gets closed, right? And today we have a provision of closer to 350 plus crores on our balance sheet on warranty guarantee. As far as Q1 is concerned, there was an additional impact of 30 crores coming out of this provision. Which was budgeted. So let me be very clear saying that it wasn't something which was budgeted, and even with that we believe we should get margins of 4.5 to 5%. So that is as far as the provision is concerned, because now all businesses we are doing it at 1.5%.
Okay.
Secondly, we had some donations, which I do not have the exact numbers with me, which were not tax deductible, which happened in Q1, which was again one-offs. Which we shouldn't be seeing going forward, and that's why our tax rates are high. And again, as I said, that was also budgeted, right? So this was not that our targeted numbers changed because of that, but those are all provisions which happened in Q1.
And you said forex loss was about 17 crores, right? Above EBITDA.
Yeah, so that is definitely a one-time. So our subsidiary Fossil in Brazil has taken a loan from Exim, which is hedged for the next 5 to 6 quarters in terms of repayment. There was volatility in the Brazilian currency over the quarter end, which has now again come back to reasonable levels, and which had a gross impact of 24 crores and a net impact of 17 crores in our consolidated numbers. We believe that's more about timing, because we are hedged for the next 5 to 6 quarters already for repayment, and this could come back in the next few quarters for sure.
Okay. So my second question is on the promoter stake sale in this quarter. So typically what we have seen is that most of the time when promoters stake sale is guarded by kind of covenants on debt. So does it in any way impact has it already, like some of the banks would have invoked these covenants and we need to refinance some of these debts? And if yes, then what point of stage like we are there in terms of refinancing? Have we already secured the new funding lines if that has been triggered?
So Parikshit, yes, there were covenants on promoters' stake level. I think we have had discussions with the bankers during the last 1 month, on this matter, and the bankers have understood and supported us in this process. A lot of covenants have already changed. Some of them are getting changed. We did not have any significant impact on the banking side, although temporarily for a few weeks there was this conversation and all of that. As we stand today, all our banking lines are fully functional, all our lenders stay committed to us, and we do not see any concerns on that front. Also, the stake sale was primarily, directed towards a filing of DRHP by a real estate business. We've been given to understand by our promoters that the documentation is at advanced stage and the filing is expected soon.
So thanks for touching that point, because if the filing happens, and if in case of, say, eventual listing, so how does it change the entire promoter pledging on? Because then it becomes like pledge on this company for a loan given to the entity, suppose it gets listed. So how does the pledging change that? You think there's a pathway wherein the pledge will reduce to zero in that scenario?
So our discussion with promoters over the last few years on this matter has been very, very clear. They believe it will continue to come down and gradually reach those single digit, if not lower numbers in the next few years.
Even post-listing, their pledge will continue, or do you think after listing of the real estate entity, there is no relation between the two in terms of, do you think that still the KPL will continue to support through the pledges to the promoter listed entity?
So I do not have the exact timing on that, Parishit, but our discussion, as I said earlier, is that it will continuously come down. Now, whether will it come down significantly post-listing or will it happen a few quarters from now is something detailing which we'll have to discuss with the promoters. But the good part is the guidance is it has to come down, one. Second, if you look at the loan against shares, just pledge, the margin money is closer to 4 times. It's only closer to 500 crores is what is the loans against shares which the promoters have taken, which is like very low with very high margin money. So I think gradually it should come down. I do not have the exact number which has been told, but gradually going forward, it should come down to a low single digit, if not closer to zero over the next few years.
Okay. This is the last question, sir, on this. So given the kind of growth we are seeing in the segment, both T&D and real estate both are doing well, and even internationally you've been able to secure large contracts. So do you think that the balance sheet is adequately funded? Do you think there is any need to raise funds for Kalpataru to maybe take up the growth higher, or further strengthen the balance sheet to support that kind of growth? Do you think any near-term plans to raise any funding in the company?
So, virtually in the near future, in the short future, I don't see any reason why we should be looking at dilution. But given the growth which is happening and given the kind of opportunities visible, we will definitely reevaluate this getting into maybe in the next few quarters. But as of today, I think we are adequately funded to take care of our existing order book and delivery on that.
Okay. And this VPL and Indore real estate, any update? If you can update us. I think VPL said that we are in terms of closing it. So how much quantum of loss funding for the year as a whole will reduce with this? And on Indore real estate, what is the pending to be collected, and what are the collections for this quarter?
Sure. So I will first speak about VEPL. As I said earlier, on VEPL, we've got some offers. We're in advanced stage on discussion with one large global investor who's given us a value which is better than what we have invested. The discussion on various shareholders agreements, SPAs, which is going on. I personally believe we should be signing the agreement at least in the current quarter. As I said earlier, I think we will get much more than, or we'll get more than what we have invested as far as VEPL is concerned. On the Indore asset, our sales in Q1 25 was around 23 crores. Our collection till date is 353 crores, and balance to be collected is around 147 crores. We have around 20% of shop/residentials which are yet to be sold, and we believe majority of it should be sold in the current financial year itself.
Okay. This last question, sir, if I may. What is this investment's total current at the current juncture? What is the total investment in VEPL?
So you're talking about from both equity and debt perspective, or only equity perspective, so enterprise or only investment?
Both, if you can help us understand both, so how much will be.
So if you look at VEPL, our total investment as far as equity, including all the funding, is closer to 386 crores.
Okay.
And the debt on it is around 280-85 crores, in that range. I could be off by a few crores, but 280 to 285 crores.
And when you talk about getting more than equity, then the 386 is the equity you're referring to, or you're referring to the original equity?
386 is the equity I'm referring to.
Okay, sir. Thank you, sir. Those were my questions, and wish you all the best.
Thank you.
Thank you. The next question is from the line of Prathamesh Solanki from PL Capital. Please go ahead.
Thank you so much for giving me the opportunity. Good morning, sir. So, sir, my question is a general bookkeeping question. Just wanted to know the order inflow from the Fasttel subsidiary from Brazil. And another thing, the order inflow breakup segment-wise for the current quarter, that is breakup for 3,182 crore, if you could help me with it.
Sure. So I think if you look at the breakup for current quarter, the current quarter order book, including what we have declared today, is around 7,000 crores. The breakup of that is T&D is 3,400 crores, of which transmission domestic is around 860 crores, transmission international is around 1140 crores, and LMG Sweden is around 1,373 crores. Our B&F business has got around 2,300 crores, and the water business has got 1,350 crores. So our order inflow for Q1, including today till now, is around 7,000 crores, and that's the breakup. We have not seen any order coming in Fasttel in Q1.
Okay, Fasttel has no order inflow. Got it. Sir, furthermore,
Q1 we don't have.
So, yeah, got it. So further, the L1 position mentioned, which is 5,000 crore, if you could give us some more color on it, like which segment dominates the L1 position?
So in the L1 position, transmission domestic is significant with more than 50%. Transmission international is around 25%, and B&F SIO is around 25%. Building and package business is around 25%.
Okay, thank you so much for the clarification, sir. Good day.
Thank you.
Thank you. The next question is from the line of Nidhi Shah from ICICI Securities. Please go ahead.
Hello, thank you so much for taking my question. My first question would be on the international order booking. So I understand last year the percentage of international orders inflow was higher, and this year it's lower back to like FY23 levels. So what is sort of your commentary on that?
Yes, sir. If you look at our order inflow for first quarter, it's 65% domestic and 35% international. But if you look at our order book closing at 57,000 crores, it's 55% domestic and 45% international. We believe that opportunities exist in both domestic and international business. But given that on the international business, we had some very large orders last year, including the Saudi Aramco and a few international orders. The last year's inflow on international was much higher. In the current year, I believe that we should be more in the range of 65 domestic and 35 international, or maybe in the range of 60-40.
All right. And my second question would be, what do you think of the pipeline this year for orders, domestic and international? How do you see the competition in bidding, and what do you think overall where this sort of sector is going this year in terms of awarding and bidding?
So as I mentioned earlier during my opening speech, I think we are seeing a lot of traction coming in transmission, building and factories, and oil and gas international. That's something which we continue to be very bullish on. Even water sector, we're seeing a lot of tenders coming, but although they're slightly delayed given that 3-4 months of elections. So across at least majority of our business except railways, we see a lot of traction. Competition continues to be there in all segments. I think it's not as much about competition as much as about your ability to deliver in the time frame which you commit. I mentioned this earlier that this is a scenario where we need to be selective in picking up orders because there is a lot of opportunity, but we need to be careful of our ability to deliver. Right? So our focus is more on picking up profitable orders across all segments, which will further drive growth getting into 25-26.
Okay. Oh, thank you so much.
Thank you. The next question is from the line of Ashwini Sharma from MK Global Financial Services. Please go ahead.
Yeah, thank you very much. Good morning, sir. Sir, just to extend the earlier participants' questions. So we have already done some 7,000 crore order inflow, and we have guided for 23,000 crore order inflow. Given the so much of opportunities, I believe that this number is a little conservative number. Wanted your sense on that.
So, I wouldn't call it a conservative more than a realistic number, and I'd just like to pause back and take you through our historical order book growth. Last year, our order book closer to double. 30,000 opening, we were at closer to 59,000 crores. We are growing at 15 to 20% for the last 2 to 3 years. Right? Our business for growth requires all three. One is capex, second is labor, and third is a strong delivery team. We believe that there are times where we need to be conscious in terms of looking at those projects with selective clients where there's a reality in terms of delivery requirements. So that's why our focus is a lot more on businesses which we are very strong in, because these are the areas where we believe that profits would go up because our capability and competency to deliver at the shortest time frame exists. So I wouldn't call it conservative rather than being realistic, because we are sitting on a 2.5 years order book while we speak. Given the volatility, given the kind of changes in labor law regulations or any of those which could come in, it's better at this time to be more realistic rather than being aggressive in terms of growth itself. That's a philosophy the entire senior management has decided. But even with this number which I have given you, visible growth for the next few years still looks like a high double digit with improved profitability and improved ROC ratios. And that's our largest focus rather than only looking at top line growth.
Right, sir. And sir, what is the kind of capex that you are looking for to fund this guidance from the execution point of view?
So we are targeting capex in the range of 500 to 600 crores in the current year through a mix of capex on the balance sheet plus lease plus a combination of few others. But we're targeting a capex of 500 to 600 crores for the current year. We believe that this requirement should reduce in the next year, given that the current year has a lot of capex on some urban infra businesses which we got large projects last year, and also on staging and shuttering a large project which can be used going forward on different projects. So personally, I believe the capex number should start going down in the next year, but current year should be in the range of 500 to 600 crores.
All right, sir. Thank you very much. Those are my questions.
Thank you. The next question is from the line of Arafat Syed from InCred Research. Please go ahead.
Yeah. So thanks for taking my question. So my first question is on order pipeline. Can you please quantify it in terms of value, what kind of order pipeline you are looking for next 1 year?
No, I think, as I mentioned earlier, we're looking at inflows in the range of 22,000 to 23,000 crores. And which means typically, different segments we are at a ratio of some segment we do 20%, some segment 10, 25%. So it looks very healthy in terms of order pipeline, and even the transmission business we see tenders of closer to 50,000 crores being bid in the next 3 to 4 months. So whether it is transmission, B&F, water and oil and gas, we will see a huge pipeline coming in. Our focus is primarily on profitable and large orders, and that's why we're keeping our targets at around 22 to 23,000 for the current year.
Fine, sir. And then my next question was on the divestment of non-core. So can you please, let's say, in terms of, let's say, what will happen in FY25 and how we are looking for FY26 in terms of divestment of non-core? And also, what amount you are expecting from, let's say, these divestment? And again, lastly on, let's say, the likely to be, let's say, gain or burn from this investment or the last year, few years you have done?
So, our non-core, what we have declared are primarily the road assets, primarily Indore and primarily Shubham Logistics, right? This is what we have declared non-core earlier itself. Out of the road assets, the largest road asset, which is more than 70% exposure, is VPL, and I said that earlier, that we expect to sign an agreement in Q2 itself on that. The other two assets are very small in value and have a very short duration left from here. So we're not sure whether we'll be selling it or just going through the process of keeping it on books for the next 5 odd years. because the investment in those assets are very, very low as compared to what we have on VEPL. So if you look at the total investments in the other two assets, if I look at BBEPL, it is closer to 91 crores, and if I look at WEPL, it's closer to 300 crores. And VEPL is something which we are looking at exiting now. As far as Indore is concerned, we believe that we should be out of the entire investments in the next 12 months, as indicated earlier. Shivam Logistics, it will take us some more time. The business is on the revival mode. We are also selling off some of our warehouses and assets which we had. The debt numbers at the Shivam Logistics are continuously coming down. So that's a business we will not look at divesting in the current year, but focus on it getting into next year or the year after that. So to answer your question, current year is going to be one road asset and Indore. Then look at the next two road assets next year, and then look at Shivam the year after next. As far as the answer on saying that, do we expect to get more than what we have invested? Our first ballpark belief is that we should be not having any losses on our investments in totality on this asset.
Fine, sir. That's really great. So lastly on railway, so basically if you look at it, the railway for you is down 45%, while for your competitor also down almost 37%. So any sense on that, let's say this was largely due to election quarter? Or you believe, let's say, going forward also the tender pipeline and that has reduced significantly as your election is largely over? So let's say in terms of doubling, tripling, how it's going, let's say if you can guide on that.
I think on the railway business for the last couple of years we've been bearish given the intense competition in this business. So we have hardly picked up any large orders in the last 2 years in this business. The business still has an order book which is around 3,900 crores to be delivered. So given that we've not taken any large businesses, we believe that it will continue in a degrowth mode at least for the current year. Going forward, once the competition comes down, we might have some opportunities in the domestic market. Parallelly, we are looking at the international market for the railways business. And I'm hoping that in the next 12 to 18 months, we should have some wins coming on the international front also. While we say so, I think current year, next year, as far as railway business is concerned, we do not see growth happening in any form.
Fine, sir. That is from my side. Thank you. Thanks.
Thank you. A reminder to all participants that you may press star and 1 to ask a question. The next question is from the line of Amit Anwani from PL Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. First question on margin. You did highlight it, PBT target margin of 4.5%, 5% and 8.5%, 9% on EBITDA. Just wanted to understand what business segments are actually going to recover on the margin front. And you also did highlight it that the recent order wins on a slightly higher margin. So if you could elaborate more on how the margin recovery is going to happen now sequentially.
So on the margin front, even if you look at the quarter one, right? I think what we have primarily lost is because of productivity not being achieved due to availability of labor. So it's not that we've had projects which bleeded or anything. So if you look at the Q1 margin also in standalone, at a PBT we're at 4.4%. It's not that we have gone down significantly. So my belief is that all segments which we had budgeted, right, could continue delivering on margins, whether it's B&F, TLD, TLI, all of them. Now that labor has come back, now that collections have started improving in a few businesses, we see productivity also improving from Q3 onwards. Q2 obviously has always had an impact of monsoon, right? So it's not any specific segment. It's the business as a whole that we believe that we will continue to deliver on what we have targeted, and that's how it will be more in the range of 2.5 to 5%.
Sure. So, and second thing on the international versus domestic, you did highlight it domestic to international between 65 to 35. So segment-wise, just wanted to understand in international market which segment will be going more aggressive. And second thing, so you did highlight it that we have been selective in terms of taking orders. So how is our strategy in international markets with respect to order taking? and which segments you feel will contribute more to the international intake?
So even in the current order book, international, significant portion of the international order book comes from the transmission segment and oil and gas, the large Saudi Aramco project. Going forward, if you ask me in the current year, I think we continue to be primarily focused on transmission business, oil and gas in a few geographies, and urban infra in a few geographies. But my own assessment is in the current year, more than 70% of our order inflow should come from the transmission business itself.
Okay. Thank you. Thanks for taking my question.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. Ladies and gentlemen, if you wish to ask a question to the management, you may press star and 1. The next question is from the line of Bharat Sheth from Quest Invest. Please go ahead.
Hello.
Hello. Yeah, am I audible?
Yeah, you're audible now.
You said in your initial that LNG we have seen potential growth.
Sorry, you're not audible. Bharat, you're not audible. Sorry, you'll have to.
Now,
you're not
am I audible? Is it clear?
Yeah, it's clear now.
Sir, in your opening remark, you stated about this LNG, we are looking for aggressive growth as well as in parcel, we are break even. So if you can give little more color on both these companies.
Sure. So I think on Lindsay Montage, our last 6 years journey has been very good. The business itself has become 3 times over the last 6 years after we acquired, and they paid us a significant amount of our investments back as dividend as far as Lindsay Montage is concerned. Today, when we look at where Lindsay Montage is in terms of our order book, if you look at the revenue for the Q1, they did around 449 crores, a growth of 84%, as compared to 244 crores in the previous year. And also their order book visibility is so good that we believe that growing at a good double digit should not be a challenge for Lindsay Montage. They have an order book visibility of around 3,000 crores while we speak, which is closer to doubled in the last 1 year. And the markets continue to be bullish as far as the entire Sweden, Norway, Denmark is concerned. And we believe that's an opportunity which we will be focused and capitalizing on. We are today among the top 3 EPC contractors in that country on the transmission side with a strong team and a presence across transmission and substation both in Sweden as well as Norway. So, even on balance sheet, that business has free cash available on balance sheet, so it's like a debt-free business. So EBITDA is equal to PBT as far as that business is concerned. On Fossil, it was a painful journey over the last 3 years because of COVID, Brazil, all of that, and historical orders, but we are now out of all the historical orders. Our revenue for Q1 25 is around 230 crores, a growth of around 40% compared to what Q1 24 we did. Fossil order book has also doubled. We are sitting at around 1,200 crores as of now. We believe that the business will get into profitable mode getting into Q2, Q3 itself, right? And going into a high growth and margin mode into the next year. So both the businesses today, I believe that growth is visible, the team is good, the markets look good, and we are conservative at least on what not to do in both the businesses. So from a perspective of direction, I think we stand committed to those businesses. The opportunity looks good and growth is visible. For the current quarter, clearly we had a small setback of effects coming into the Fossil business, which I just explained in the earlier call, which to me is more a timing issue. It was a net 17 crores impact. Otherwise, if you look at Lindsay Montage for the current quarter, they have done a EBITDA of closer to 4% or closer to 5%, and even Fossil has done a EBITDA, at the range of 8 to 9%, which is what we believe will continue to improve.
So even sir, in Lindsay Montage, do we expect improvement in the margin from say 4% earlier? We were doing 6% kind of EBITDA margin, and kind of a potential in next 3 years. Where do you see this Lindsay Montage as well as Fossil?
So on Lindsay Montage, we definitely expect margins to improve getting into Q3, Q4 itself, right? Not even next year. And getting into next year, we definitely should be at 6%, if not higher than that. On Fasttel, our EBITDA has been closer to now is at around 8.5 to 9, and we see that going up going forward because that's a business that's a market where 10 to 12% EBITDA is common in terms of T&D projects. So yes, EBITDA margin should go up on this business going forward, and next year for sure Fasttel will be 6% plus.
Okay. Thank you, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Vaibhav Shah from JM Financial Limited. Please go ahead.
Yeah, thanks for the opportunity. So firstly, when do we expect the execution to start for Aramco project in terms of revenue booking?
So the execution in terms of team building is fully done. We are close to 150 people who are already at the site now. 150 and could be even more than that. 150 is when I was there a few weeks ago. The design engineering phase of the project has started fully. In terms of revenue, I think you should see significant revenue coming from maybe December onwards on this project because our design engineering significantly would be done by November, December. And that's when the site activities would start in a big way. As I said earlier, this project does not involve buying of pipes, right? Pipes is a pre-supply from the client. So it's at the site where the execution, whenever it starts, is when revenue comes in. So we believe that Q4 we should start seeing a lot of it, and December onwards, Saudi Aramco revenue and margin should come in.
So any guidance on full year FY26 revenue or margins for the project, ballpark?
It will be difficult for us to give a guidance today, but today we're sitting on a 2.5 plus years of order book, right? And given that the positive environment around, I don't see a growth in having a high double-digit. I don't see a problem in having a high double-digit growth, but I wouldn't like to give the guidance at this stage. Maybe by the end of Q3 or beginning Q4, we would be giving guidance for next year.
I was asking for the Aramco project.
So Aramco projects, I think the delivery is scheduled over 36 to 42 months. So the peak of that project would be the next 25, 26 and 26, 27. So if you ask me in terms of revenue, I think the next 25, 26, 26, 27 should be more closer to 70% of the revenue of that project. 10 to 15% might happen in the current year and the balance in the last year.
Okay. So secondly, you mentioned the order inflow guidance of 22 to 23,000 crores for FY25. So that is on standalone level or console level?
So I think that is the guidance at the console level which we are giving, with standalone closer to 20,000 crores and the subsidiaries in the range of 3,000 crores.
Okay. And so lastly, in terms of revenue growth for Fasttel and LNG, how are we looking for FY25?
So as I said earlier, I think this question I had mentioned earlier also, both the businesses would grow at a 20-25% plus for the current year. It could even be higher, but the budgets are at 25% plus and with profit improvement. So I don't see challenges in both the business growth as far as the current year and the next year is concerned.
Okay. Thank you, sir. Those are my questions.
Thank you. The next question is from the line of Parikshit Kandal from HDFC Securities. Please go ahead.
Yes, thanks for the follow-up. My question is on, so you highlighted that 70% of inflows this year will be from T&D. So I just wanted to understand, are we looking to increase any capacities on tower side? Are we looking to set up any conductor capacity or cables capacity?
I think our tower manufacturing capacity is in excess of 200,000 tons, and I don't think we need to increase that with the current visibility, at least for the next few years. We are not in the cable and conductors business, so and we do not have any plans currently of getting into that business. But as far as capacity at the plant side is concerned, we believe that we have enough capacity to take care of our growth requirements.
Okay. The second question is on this retail asset monetization. So how do you intend to use the proceeds? Do you think that it will be appropriate to repay the debt of the balance to assets and reduce loss funding? So how are you strategically thinking about utilizing these proceeds? And what is the current level of loss funding or putting support? I think even in this quarter you supported in excess of 20 crores. So for the year as a whole, how much would be this number? And with monetization, how much that number can come down?
Sorry. So let me first answer the second question. We had guided for a 70 to 75 crore support in the current year for the businesses, primarily to repay debt. We believe we should be in a similar range given the traffic growth. It should only come down and not go up. As far as utilization of proceeds, I think we've really not gone into that detailing as of now, because after we sign the binding agreement, all the approvals could take any time between 3 to 6 months, right? So we will have enough time during that time to decide. But clearly the proceeds could go either for debt reduction or for growth on capex. There's no other way. It's only one of the two, or paying back as dividend to shareholders. It's only one of the three. So it's early for us to start discussing on that, and we've not thought on that as of today. Once we sign the binding agreement, once we start getting approvals, is when we will be getting into focusing more on how to use the proceeds.
And post-acquisition, how much could be the reduction in debt in the last one? I mean, is VEPL, are you supporting anything, or is it 75 crores in VEPL? Because I understand last part is going towards Rail Ganga.
So VEPL Q1 we gave around 5 crores. So I think we will continue to support in the range of maybe 5 odd crores on a quarterly basis, not more than that, unless it's for any debt repayment. So I don't have the exact numbers. So total all three put together we paid 25 crores, but VEPL was not higher. The high was WEPL, which we supported in Q1.
So that will continue, I mean, despite this monetization, that 70-75 crores kind of support will continue.
Current year it will, because, as I said, even if once we sign it, getting all the approvals is a journey, right? It takes 3 to 6 months. So even we are sitting in July, August, we sign it, it could be January, February. So current year, definitely we believe the support will be required.
And what is the WEPL debt, sir, right now? I mean, for which you are giving the bulk of the support?
107 crores.
So that's it. I mean, so even if like you get to your...
So that's what I said. Next couple of years is what the entire debt will be over. So if you look at it on a debt basis, the debt on our three assets put together is only 425 crores. With 285 crores on VEPL, 107 on WEPL, and only around 35 crores on BVEPL. So I think the debt support would get over. And after that, we'll still have a long life. The assets would still have one of them has a life of around 18 to 20 years, one of them 7 to 8 years, and one of them again 5 to 6 years.
Okay.
So,
got it, sir. Thank you, sir.
Thank you. The next question is from the line of Tina Varmani from Motilal Oswal. Please go ahead.
Hi, sir. My question is related to the execution growth for the company. So Q1 was weaker, and it was expected to be weaker also because of labor-related and election-related impacts. But how will execution ramp up in the coming quarters for the standalone entity? Because if railways is going to be weak, so will other segments grow faster than 20% to take care of your full year growth guidance of 20%? I just wanted some of your thoughts on this.
Sure. So, in the current year, majority of our businesses are growing at 20% plus. So whether you look at TLD, which is transmission domestic, whether you look at buildings and factories, which is the entire country, southern as well as the northern and western, whether you look at our international subsidiaries or whether you look at water, urban infra, oil and gas. So if you look at each one of these businesses from a revenue perspective, they build up a good order book at the closure of the last year, right? And there is good visibility going forward also. So all our businesses are growing at anywhere between 15 to 25% at individual business level, except railways. So the key growth drivers will be across all business. Because oil and gas would literally grow at maybe 50% plus because the base was small and Saudi Aramco is a big number. TLD was not growing for the last 3 years. Now we've seen a good order book and good L1, so that business will grow at 25% plus. And even in Q1, we have seen transmission grow at that number. Right? Water business has a very good order book. Q1 was down because of, as I explained earlier, labor as well as, this connection issues. In building and factories, we have seen a growth of 23% in Q1 itself, right? And even with labor issues. So obviously getting into Q2 or Q3 onwards is much higher. So all our businesses except railway would grow at more than 20% for sure on an annualized basis. And that's why we are guided for that number, which is in the range of 20%. And railways also on an annualized basis will not be a huge degrowth, right? While there will be degrowth, it's not that we are looking at reducing it by half or something, because they still have a visible order book. And the size is so small that on a larger number, the impact is very minimal.
Right. So water segment, which was impacted in Q1, water would start growing in the coming quarters. There you don't see any challenge.
Yes. So given the impact of Q1, would they grow at maybe 20% annualized? Could be less, maybe 15 to 17, maybe not 20. But other businesses will do much better. So even with the Q1 impact, we believe that at a consolidated basis, growing at 20% will not be a challenge on majority of the business.
Got it. And what is the size of these urban infra projects where you're required to incur this large capex, primarily for the tunnel boring machine and other things? So what is the size and by when these projects start contributing to execution?
The urban order book is closer to 3,000 crores while we speak, with 2 underground projects and a few overhead projects also. As far as Q1 is concerned, if you look at that business grew at 18%. They did around 181 crores compared to 154 last year. Urban infra as well as civil international put together, because that's also urban in nature. So I believe that with a visible order of 3,000 crores, they should be growing at more than 35% in the current year, because they had a very low base in the previous year.
Okay. And so will this capex, which you have already done this year as well as which you have already done the last year as well as you'll be doing this year, this won't be a significant number in the coming years?
So my own belief is that at least on TBM, we shouldn't be seeing significant investments coming in unless we get some good profitable orders in Q3, Q4. But, as I said earlier, it's all about making sure that we get profitable orders when we can afford to do that capex. But in the current order book, I think this would be a big year of capex, and capex should go down going forward.
Right. So this 500-600 crore that you're targeting, that is primarily for these urban infra-related projects itself, the capex.
So it's a mix of all three. It's urban infra, which would be maybe 1/3 of it. It would be the staging and shuttering and formwork for INU business, which would be 1/3. Then there would be another 10 to 15% for the international businesses given the growth, and balance across all other businesses.
Got it, sir. Got it. Thank you. That's it from my side.
Thank you. The next question is from the line of Ashish Shah from HDFC. Please go ahead. Hello, Mr. Ashish. Your line has been unmuted. Please go ahead with your question. Mr. Ashish Shah, your line has been unmuted. Please go ahead with your question.
Hello.
Yeah, Ashish.
Yeah, so sorry for this. My question was about this particular event where we were made party to one dispute in NCLT earlier this month in respect of one of our terminated projects. If you can just update a little bit context of that event and also any implications that it may have for the company. Thank you.
Sure. So, this was a Kurukshetra Expressway, which, we had terminated 2 years ago because of the farmers' agitation, and that termination was the road asset was handed back to NHAI. We had already written off our entire equity on that asset in 22-23 itself, and today our carrying value is closer to zero as far as this asset is concerned. This entire proceedings were started from the bank against NHAI, where we are party to it. So the bank has gone to NHAI for debt repayment based on, the concession agreement, where banks are eligible for the debt repayment because it's a termination on account of a default by NHAI. So that's where bankers have gone against them, and we are a party to it. As far as we are concerned, I think we have completely written off our equity on books, and we shouldn't see any impact on it in any form. Finally, on this asset, we also have into arbitration on a couple of. We have right now 2 arbitrations which are going on, which we expect in the next 3 to 6 months and awards to come in whatever form. But otherwise, as we stand today, we do not see any hit coming out of this proceedings in any form.
Right. Sir, in this particular termination matter, has NHAI accepted our argument for termination, or that part itself is something that we are arbitrating on?
So I will just ask SKT to also speak on this.
Yeah. So as far as the NHAI is concerned, they have taken over the asset and they are maintaining the asset. We are out from the asset about 1.5 years back. Now, as far as the debt settlement is concerned, as expected, NHAI will not walk an easy path, and they are giving tough time to the bankers and to us also. But as Manish commented that we are in the arbitration on these projects, on the termination payment, as well as we are persuading bank also to come on the same platform, and we may see some resolution over, say, next 3 to 6 months on this matter.
Sure. But as we see it today, there is no impact on the company in terms of any residual liability on the debt repayment.
Right. There is no liability.
Right, sir. Thank you.
Thank you.
Thank you. Ladies and gentlemen, this will be the last question. It's on the line of Riya Mehta from Equitas Investments. Please go ahead.
Thank you for giving me the opportunity. I have two set of questions. First, in regard to the supply chain challenges which we were speaking earlier in quarter, and I think one of your competitors also put up a line for conductors. So are we seeing similar supply chain challenges, and are we looking out for similar capex?
No, so from a supply chain perspective, at least at a KPI level, while we've seen some delays, I wouldn't say that these are challenges which are impacting project delivery. We've seen some delays of a few months. While we speak today, I think on a Q1 basis, whatever we projected in terms of delivery and supply chain has happened at 95% plus. And getting into the balance part of the year, based on commitment from all our suppliers, we believe that we will not have challenge in supply chain, at least based on the current environment, whether it's on conductors, insulators, or even transformers. As far as our plans for setting up a plant to look at that options, as I said earlier, we do not have plans as of now, because we believe that the industry already has visible capacity to take care of the requirements of the country, and to that extent, we would trust our suppliers who deal with us for long enough. So as of today, we do not have any plans to be getting into that business of cables and conductors.
Got it. And in terms of T&D, where are we seeing demand primarily from domestic or international? And domestic, which is majorly PGCIL led?
Yes, so at least in the last 6 months, we've seen transmission domestic more than 90% orders coming from PGCIL. So that is driving growth in a big way. As far as international is concerned, we're seeing opportunities everywhere, whether it is Africa, whether it is Middle East, whether it is Latin America, whether it's the European market, or the Australian market. So we continue to stand bullish on that, and that's an opportunity which looks very attractive as of today.
Got it. And my last question is regards to the workforce challenge which we face. So that is, in what layer of employees are we seeing workforce or an unavailability of labor? Is this from the skilled or semi-skilled or what?
I think that's a challenge across the value chain, right? So whether I look at skilled, whether I look at semi-skilled, unskilled, whether I look at international projects, domestic projects, and even supervisory staff, right? I think that's a challenge right now, which is the biggest challenge for the industry as a whole. Given that the growth has come in the last few years has been very huge, right? It's beyond expectations that what was coming in now. And the delivery schedule is only reducing as far as all projects are concerned, right? Some driven by the pressure of the government, some driven by RERA, some driven by other regulatory requirements. So with delivery...
Sorry, go ahead.
So given that delivery schedule has reduced and the expectations have only gone up, so I think it's a challenge across the entire value chain. So today, if you ask me, the number one challenge is not order book, not revenue, not growth, not profitability. It's only about resources.
So do we tie up with agencies, or do we have hire directly these or have contractors, or how is the mechanism for manpower?
So I think it's a mix of everything, but we hardly use any agencies. It's been more our own team and our contractors who work with us. We rarely use agencies, but it's a mix of everything depending upon the project, the country, the kind of work, a combination of all of that.
Okay, thank you so much. That's it from my side, and all the best.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today's conference call. I would now like to hand the conference over to Ms. Bhumika Nair for the closing comments.
Yeah, I would like to thank everyone for being on the call, and thanks to the management for giving us an opportunity to host the call. Thank you very much, sir, for answering all the questions, and wish you all the very best.
Thank you very much, Bhumika. Thank you, everyone.
Thank you. Thank you.
On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.